Learning Objective 11-2. Understand the accounting implications of and be able to make calculations related to foreign currency transactions. And foreign currency transactions are economic activities denominated in a currency other than the entity's recording currency. In other words, if you're in the U.S., you do almost all your business in U.S. dollars, and you prepare your financial statements in U.S. dollars. And that's really what's key is what you keep your books in. So if you keep your books in the U.S. dollars, and we're going to talk about this further in Chapter 12, then any transaction using a different currency than U.S. dollars is going to be considered foreign currency transactions. And examples of foreign currency transactions could include buying or selling goods where the price is stated in a foreign currency rather than U.S. dollars, loans payable or receivables in a foreign currency, the purchase or sale of foreign currency forward exchange contracts, which we'll talk about, and the purchase or sale of foreign currency unit. And this is actually very simple. For financial statement purposes, transactions denominated in a foreign currency must be translated into the currency that the reporting company uses. So if you're in the United States and you're transacting in euros, then you need to translate your transactions from euros into US dollars. And any balances that you have on your balance sheet need to be adjusted as of the balance sheet date to US dollars. So what happens is you may have, let's say, a receivable that's denominated in euros, and someone owes you 1,000 euros. The value of 1,000 euros in US dollars is going to change constantly. So every reporting period, at the end of the period on the balance sheet date, you're going to need to restate the value of that receivables into whatever the US dollar equivalent is of 1,000 euros on that date. And this will be a gain or loss, and it's going to hit the income statement with a few exceptions that we'll be talking about. So let's talk about foreign currency import and export transactions, and that's where we'll start, and then we'll go into forward exchange contracts where things are going to get a little bit more interesting. And when you engage in the transaction, as of the transaction date, you record the purchase or the sale at whatever the US dollar equivalent is on this using the spot rate on the transaction date itself. And then as of your next balance sheet date, if there's a payable or receivable that's denominated in the foreign currency, in other words, it's for a certain number of euros and a set of dollars, let's say, then you're going to translate that value into whatever it is in dollars as of the balance sheet date. And any gain or loss is going to hit the income statement again. Then you're going to have something called the settlement date. The settlement date is when you get paid for your receivable or where you pay off your payable. And you're going to settle it on whatever the current exchange, the spot rate is on that date. And that'll be called the settlement. And you'll record it at the US dollar equivalent of whatever you paid or whatever you received of the foreign currency. So basically everything gets translated again. It gets recorded at the US dollar equivalent on the original date of transaction. It gets translated into the new value, in other words, marked to market value, so to speak, on your next balance sheet date and any subsequent balance sheet dates. And then you have what's called the settlement date, where you would record any additional gain or loss when you either pay off your payable or you collect your receivable. And the book differentiates between what they call a two-transaction approach and a single-transaction approach. Reality is that these things are always going to be done as a two-transaction approach. And let's say you owe a certain number of euros. Then your first transaction is going to be to sell dollars. It's going to be to purchase your euros. Then you have your euros, and then to pay off your payables. If you have a receivable in euros, then you're going to collect a certain amount of euros, and then you're going to sell the euros and receive the US dollar equivalent. So it's really two transactions, and you're going to need to record a gain or loss. Again, whenever you have any of these translations, inevitably there's a gain or a loss. So let's suppose on January 1st, 2021, a US company acquires 5,000 euros. And at the time, the direct exchange rate is $1.20. In other words, that's a direct exchange rate, meaning that €1 costs $1.20 to purchase. So 1,000 euros would cost $1,200 to purchase. And the cost of the transaction at the time is $6,000. Because 5,000 times $1.20, 5,000 euro times $1.20 value would be 6,000 euro. So here, we're giving up $6,000 in order to get 5,000 euros. So the easy part of the transaction is going to be credit cash for $6,000. And the thing is, we keep our books in dollars, so everything is kept on our books in the US dollar equivalent of whatever it is. So even though I'm going to call this account foreign currency units, and EUR is the abbreviation for euro, I'm still going to value it at $6,000 because that's the value of 5,000 euros in dollars. And everything in my balance sheet is going to be kept. Everything on my books is going to be kept at the US dollar equivalent. It's not kept at 5,000 euros, and the rest of the books are kept in dollars. Now, July 1st, the direct exchange rate at the time is $1.10. And I'm going to adjust this to market value. So at this time, the market value of these euros has declined to $5,500 because it's 5,000 euros times $1.10. Direct exchange rate would be 5,500. You got to be very careful that you're multiplying the foreign currency by the direct exchange rate, and that you get that direction right, because a lot of students will multiply when they need to divide, and vice versa. So what I'm going to do here is I'm going to adjust this to market value and credit foreign currency units and indicate what currency it is for this loss of $500. And the debit is going to be debit loss, or I'm going to abbreviate foreign currency as just FC, translation loss for $500. And that will, in effect, record the decline of value on my balance sheet. Now, let's consider some more advanced transactions. We're going to record transactions again at their current value, and then do mark to market at the end of each period, so that the balance sheet is all recorded at market value. And then again, we're going to adjust to market value before we settle any receivables and payables. So Peerless Products acquires goods on account from Tokyo Industries for 2 million yen. And it's important to notice here that this has been denominated in yen and not in US dollars. That means that they're going to pay us in yen and not a fixed amount of US dollars. And the direct exchange rates at the time, October 1st, 2021, would be $0.007 per yen. December 31st is going to be 0.008, and looking far into the future, April 1st, when we pay off the payable, is going to be 0.0076. So first, let's engage in the transaction and buy the goods. The journal entry would, as it would always be, debit inventory, credit accounts payable. But the thing is that this is now ordinary accounts payable. This accounts payable is denominated in yen. And the value of the transaction on October 1st would be 2 million yen times 0.007, or $14,000. So 2 million yen sounds like a lot, but it's really just $14,000. December 31st, I'm going to have a balance sheet date. So previously, my yen was worth 0.007, or $14,000. And now, as of December 31st, it's 0.008. And again, when you're doing these transactions, you really want to think about and think out loud sometimes. I used to work with this accountant guy. His name was Marty, right? And what Marty would do is he would say it out loud. He would say, right now I have a payable for $14,000, but the currency went up, and the book value is going to increase to $16,000, and it's a payable and the payable is going up, therefore I'm going to need to pay more money, and therefore I have a loss. And, you know, obviously you can't say it out loud like that on an exam, but sometimes it helps you to think about it. So here the payable is going to increase by $2,000, meaning that I'm going to need to credit it. And you could, if you want, do a T account just to make sure, you know, you got a credit balance of $14,000 plus another credit of $2,000 is going to give you the $16,000 that you need. So credit accounts payable for $16,000, and the debit is going to be foreign currency translation loss. This goes right to the balance sheet. I'm sorry, right to the income statement as a loss. Now the transaction is going to settle. We've got to pay off this debt in yen on April 1st. So the first thing that I'm going to do is I'm going to adjust the value. Now this is on my balance sheet for $16,000. But the exchange rate on April 1st went down to 0.0076, meaning that the balance sheet value can be brought back down to 15,200. So if the payable is going down, that means I have a gain. So I'm going to debit accounts payable. And it's very important to note there in the name of the account that this is in yen. And again, it may help you to do a T account. And the transaction is going to be foreign currency translation gain. There's a few, now I just want to comment on that. We use a gain account for the credit and a loss account to debit. And you might ask, why don't we just don't use one account to net them? The FASB is not clear that you're allowed to do that. So what a lot of companies will do is they'll report a net gain or a net loss on their income statement, and sometimes they'll combine it with a lot of other items. But somewhere in the notes, what they'll usually do is they'll disclose them separately. In other words, they'll show the gross gain, the gross loss, they'll offset them and show you the net gain or loss. So we do have to keep track of foreign currency translation gains and foreign currency translation losses in separate accounts. And from what I understand, I'm not 100% sure of this, the FASB never said that you have to do this or not, that you have to gross up your gains and losses and then offset them in the financial statements themselves. But it's common practice for companies to do that. And since you have to disclose these numbers separately, then you don't have to, but everybody seems to do it, then you need to keep track of them in separate accounts. So it may be a little confusing that when you have a gain, you credit gain, and when you have a loss, you debit loss. But it's just so that you aggregate these separately, and then you can offset them when you need them. You can offset them and report them net, but you need to disclose the total gain and total loss, because that just seems like what everybody does. Okay, now there's a little problem here, because we don't have any yen, but we owe $15,200 worth of yen. So we have to buy the yen. So I'm going to go to a foreign currency broker, and I'm going to give them $15,200, and they're going, because that's the going value of 2 million yen is $15,200. So I'm going to give them 15,200 US dollars, and they're going to give me 2 million yen, which are worth 15,200, so they can go on my books for 15,200. Then I'm going to take my 2 million yen and I'm going to pay it to this supplier, and that's going to relieve me of my accounts payable, which is also on the books for $15,200. So the book points out that this can be recorded as one entry. I don't think that's a smart thing to do, because the purchase of yen and the settlement of the payable are really separate transactions. And I think that for paper trail purposes, you want to write this gain in a separate transaction. Nonetheless, the book says you can do it, so it must be true.